Hi, welcome everybody. Welcome to our panel on policies that work. The title of our panel today is on real estate, interest rates, and the shifting American dream. My name is Maisy Wong. I'm a professor at the Wharton Real Estate Department. And one of the great joys of being at a university is really our lifelong learning experiences. And today, I will tell the audience that you're in for a treat with my esteemed colleagues. This is a very timely topic, and I'm looking forward to our conversation. Before we start, I just want to remind our audience on LinkedIn to please submit your questions in the comment section, and the audience in the room can also submit your questions via text. So without further ado, I'm going to start our panel. And so let me start by introducing my esteemed colleagues. I'm joined by Professor Gyourko, the Martin Bucksbaum Professor of Real Estate, Finance, and Business Economics and Public Policy, and the Nancy, Nasher, and David Haemisegger, Director of the Zell Real Estate Center, and also Professor Susan Wachter, the Albert Sussman Professor of Real Estate, Finance, and the Co-Director of the Penn Institute for Urban Research. So Joe, let me go to you first. I think one of the questions I get a lot from my students is, well, the Fed has started reducing the short-term Fed funds rate. So why hasn't the mortgage rates for the 30-year mortgage rates come down yet?
Well, part of it is what you said. The Fed sets short-term interest rates. That overnight rate is the rate at which banks lend to each other, and that happens to be identical to the rate the Fed pays on reserves. So they can absolutely determine that overnight interest rate. More fundamental forces determine long-term interest rates that really are the basis for 30-year fixed-rate mortgage rates. And without getting real fancy, it's the duration of a 30-year mortgage is 7 to 10 years, something like that. So the real question is, why are the yields on 10-year bonds at 4.2 today? And they have not come down. They've come down but gone back up since the Fed cut. The way I think about it is, what's the yield I would need to buy a 10-year Treasury bond? And the answer is something north of 4%. And why is that? That's where the fundamentals come in. I think basically the 10-year rate is, roughly speaking, our colleagues in finance will get up, I'm simplifying a really huge and complex literature, is at least the sum of real productivity growth over the long run. Call that 1.5%. There's a debate. It used to be 2, it fell to 1. I'll go with 1.5%. And then inflationary expectations. I have to be compensated for expected inflation. Personally, I think that number's 2.5% at least. But 2.5 and 1.5, Maisy, is 4. And then I'll go a little bit above 4 for just term premia. That is the risk not associated with productivity growth and inflation that I've already controlled for, but other stuff, say a volatile world, that I have to be compensated for to hold long duration bonds, like a 10-year Treasury. I've just got us north of 4. I don't see it falling, and whether the Fed cuts short-term rates or not, it will not have a huge effect on those things, which means you should be expecting 6 to 7% mortgage rates for a while.
I see.
I think.
In my lifetime as a homeowner, I have had the privilege of having very low interest rates, and you're saying that I need to go back to history and reset my expectations.
This is a return to normalcy in an important sense. So I'm way older than Maisy.
Yes.
Well, my first house in 1994, the mortgage rate was 7%. That's more the norm. Susan.
Yes.
Let me just amplify, certainly agree with what Joe has said. But the mortgage rate is actually more than 150 basis points higher than the 10-year Treasury, than it normally is. So that is a puzzle. And also, we can measure expectations, and I agree with Joe that that's critically important, price expectations going forward in the 10-year Treasury and therefore on the mortgage rate. And it's 3% pretty much. So taking, which I agree, the 1.5% plus the 3%, and we get right there to a number that's north of 4%. But that's not the mortgage rate. The 30-year mortgage rate is actually 7%. So why the difference? So there's an extra premium over the 10-year due to two risks, and risks go in both directions. First, to the investor, there's the risk that inflation rates will increase. And the holding for the mortgage period for investors, for borrowers, tends to be longer than the 10-year treasury, or at least it can be longer if inflation rates increase. And of course, that's exactly what we've seen in this crisis that we're in right now, that everyone is holding on to their 4%, 5%, 3% mortgage, which increases the risk to the investor who sees rates going up but not on their holdings of mortgages. So that's one risk. But then what about if there's good news? If there's good news and the 10-year rate drops, that's not good news for, so the 10-year is 7% right now. So a drop in the 7-year 7% rate to investors means there's a huge prepayment risk. That is, at that point, yes, if it goes down sufficiently, back down to starting 6.54, then borrowers will prepay. They will repay their mortgages, and investors won't get a benefit. Some investors will get a loss, depending on their maturity and their interest rate, but there won't be a benefit. So either way, if you're an investor, you are exposed to inflation and interest rate risk. And the longer the holding maturity of your instrument, and mortgages is a longer hold under inflation increasing. So either way, the risks are higher. So in a volatile environment, which as Joe has pointed out, we're stuck. We're stuck with 7% rates, despite the fact that the Fed has decreased by 25 basis points and may decrease again. Not going to help on that critical factor for affordability.
Yeah. So she does the spread, the base rate, the spread. I agree. The spread's not going to come down. Do you think? Not much.
Yeah, I think that refinancing risk and that prepayment risk is real, and it's the degree of it is historically pretty large.
It's at its max.
Yeah.
Yeah, and because I think if you look at Google Trends and you look at people searching for refinancing and mortgage rates, it does peak around September when people are paying attention to the Fed funds meetings, and so people are waiting for rates to come down.
They sure are.
And so that prepayment risk is something.
And in fact, when the rate comes down even a little bit, there's going to be an increase, but by a few. And we're not talking about any major move until rates really come down.
Yeah. On anything else on mortgage rates before, I do want to say one more thing about mortgage, I think, which I think tees up also the research of our colleague, Lulu, at the Wharton Finance Department. And I think one other point about mortgage rates being so high right now, and people like me holding on to these low interest rates, is the lock-in effect.
Correct.
That, because I think another common question people get is, why isn't there inventory? Why aren't I able to find?
So the strange thing about this mortgage rate increase, which is due to inflation expectations increase and due to inflation increase, is that it not only raises the cost of borrowing, but it raises the cost of housing. So on both, obviously, when you buy a house, you can buy it all cash. Most people cannot, and then they're affected by the higher mortgage rates. But actually, higher mortgage rates are now imposing a scarcity factor on housing as people are locked in and are not selling their homes. And that is decreasing supply, raising the price of housing. So it's a double whammy due to the high inflation expectations and inflation of the past.
Yes, I mean, with mortgage rates, the lock-in effect really limits mobility, and that really does limit supply. And so, Joe, I want to come to you because you've written so many review articles about housing supply. What are your thoughts on supply?
Well, let me talk. I'll start with Susan's point, which is the drop in mobility. Loose paper forecasted 20 to 30%. That turns out to have been a pretty good forecast because mobility's down. Somewhere between a quarter and a third. And to Susan's point, what that means is if you're searching for a home, 1/3 of what used to be the inventory isn't there because you're not listing your home because you're not going to move. So the match quality has gone way down, and the effective supply of good matches has gone down.
What's interesting is that the inventory of newly constructed homes has increased dramatically.
Right.
So for the first time, historically, we have more of an inventory of first-time homes. And the inventory is increasing, but it's increasing from new build.
But it's, and new build just, in a typical year, between 80 to 90% of home sales are from the existing stock. So the share of newly built has gone up. The amount's not great. It's not a gargantuan number. The stock's really big. We're a mature, well-developed economy. So when you lose 30% of that, listings from the stock, that's a big effect. Longer run, then that's the short run. And I think it's not wise to think about supply only in the short run. In the long run, this has been a problem in our, what I think of, and Ed Glazier and I think of as supply-constrained coastal markets for 40 years now. And nothing's changed there. Boston still doesn't build, San Francisco still doesn't build, LA doesn't build, et cetera. That hasn't changed, and that problem's just gotten worse. It's unclear whether this will be a trend, but you are seeing lower new build intensities in big Sunbelt markets, Atlanta, Phoenix, and the like. That's new. It's a question of, is that some type of just temporary effect that was caused by the GFC? Is it supply chain snafus from COVID? Or one possibility, and we don't know the answer to this, have they gotten dense enough that they don't want to densify anymore, and we're going to see less building? So you're going to know the answer to this question.
Hope not.
If you use the government's CBSA, the Consolidated Metropolitan Area Definitions, question, in 2020, who has the more dense metro area, Phoenix or Boston? You know the answer, Phoenix, not Boston, Phoenix. So that's a key question we don't know the answer to. Are they going to start restricting supply the way the coastal markets did? That's a key long-run question.
I think we talked about a couple of things. So there's the inventory of existing homes being limited, and then new homes. We're not sure yet whether that's going to be a
We're building.
trend.
Susan's right.
There's
We're building,
homes
but
being
at a
increasing.
lower rate, sort of
not sufficient.
per person, per capita. That number's not going.
So Joe's absolutely right. Per capita, we're building at a lower rate, and it's a puzzle. And I agree with Joe that
we don't know why.
In part, it could be the response to the great financial crisis afterwards, when building stopped and people got out of the talent supply and the connections for building, because building absolutely plummeted.
Number of building firms dropped by 40%. I mean, it's a wipeout. It's a wipeout in the
total
industry.
wipeout, which we have not recovered. Then we had the whiplash. So that could be part of it. We don't know. But it is also true, as Joe said, that we are densifying where we are building. And densification is always more costly. So the new building is happening, and it's happening at a far higher share of the market than it is usual. And also, for the first time, interestingly, the price of a new home is not at a premium to existing homes, which tells us that the construction firms are building to the market. They're trying to build more affordable homes, and they are. They've decreased the size of the homes in the last 3 years by 6%, and their finishes and others. They're trying to fit the market, which would normally be the resale market, which is now dead in the water, by building more affordable. But there are limits to how much they can get the cost down. And one of the major limits is land, and whether it's available to build and more dense, which increases the availability of sites. And the answer to that appears there's real resistance to that. And also skilled labor, which is increasingly, even over the last 5 years, more expensive. And that may be out of this period where we just lost production? We don't know. And of course, we've got the future to consider in terms of, I'm sure you'll get to this, but issues of who's the labor supply and how does that relate to Trump's policies. But I'll leave that for the moment aside and go back to even right now, the price of new homes, even with this attempt to make them more affordable, is not affordable. We are at 40-year low in measures of affordability, which is why the young generation, many people in this room are younger, are having such a difficulty in becoming homeowners.
Let me put I think that's a great point. I looked this up right before I came over here. An engineering consulting firm called RS Means produces estimates of the cost of a given quality home. And the numbers I'm going to give you are for an entry level. It's Susan's affordable home. It's 1,800 square feet. This is for Atlanta in the suburbs. And it's not a fabulous home. No granite, it has Formica countertops, standard roof. An architect did not draw up the plans for this home. It's a basic entry-level home. In 2020, they think that home cost $250,000 to build, including land and the developer's profit. In 2023, they thought it cost $302,000. It's a 22% increase. That's part. Its production costs went up.
And is it
a lot?
Land?
No.
Material?
It's not just land. It's labor.
Labor.
When you look, they tell you here's what Formica costs. Here's what labor costs shot through.
So,
the roof.
Joe, I'm trying to figure that out. If inflation rate since 2019 is 20%. Are these inflation-adjusted numbers, or because if they're not inflation-adjusted numbers?
In real terms, they're not going up much.
Oh, well, that's incredibly interesting, isn't it?
Yeah,
Right, yeah.
Well, I think that factoid.
Yeah, but they're real production costs. By the way,
Wait a second. So real production costs since 2019?
Are not up much. Real or not.
It is
Inflation's up. And by the way, should you expect that to come down? No. The last time a big inflation fully unraveled and mean reverted was the Great Depression. Let's hope we don't go there.
So this is, it may seem inconsistent. I'm sure we'll get a question from bright guys out there. But prior to the question, I'll try to resolve the inconsistency. On the one hand, we're hearing that housing costs, production costs have increased with inflation, and yet, we're not. Everything's up. Eggs are up. Everything's up. And of course, everyone's complaining about that. But the fact is that housing is the big driver of the CPI. In fact, more than half of the increase in the CPI is due to housing. Yeah. So how could that be if housing is just at the CPI? The answer to it is, there's one thing is RS Means, which does an extremely good job and is extremely relevant, that Joe has looked this up, is the average cost of producing. But producers are not producing at the average cost because they're at max. They're producing overtime. They're throwing everything in. And they're, of course, charging for that, right? Marginal cost price. Why not? You have to do that. Your competitors are doing that. Your capital requirements require you to do that. So they're doing that. And that means that the equivalent new home today, compared to 2019, is 50% more expensive. So if you look at indexes, FHFA index or Case-Shiller index, they're pretty much consistent, even though there's slight differences. So inflation's up 20%, and housing prices are up double.
Yeah. The other thing to note, since 2000, housing production costs have increased more than the CPI, right? So this is a long-run issue for us that has to do with why is American construction sector
the input
so
costs, material costs, labor costs.
They're low productivity.
And this is not a marginal thing. This is the average. This is real cost. Yeah. And prior to 2000, not so much.
Not so much.
So there's a real regime shift that happened in the United States.
We became less productive in this sector at the turn of the century.
We became this American exceptionalism for us who are in housing.
Not in housing.
We used to be, though.
Yeah.
We used to be quite affordable. The ratio which is often used in global comparisons of income to price, It was in the U.S. used to be 3.
Yeah.
So if you had a house price that was, I don't know, $100,000, your income is $30,000, that's 3. And of course, you just now push it up to $300,000 to $100,000, still 3. But housing prices are today, the median house price is north of $400,000, and income is $70,000. So we're way over 3, and we're heading in many markets to 5 and 6, the markets where the jobs are.
Yeah.
So that's what's really relevant, is not just the average, but where you want to
Yeah.
move, and then we're north of 5 and 6. Still, actually, we're more affordable than most of the rest of the world, where price to income ratios in Asia, anybody want to guess? Hands up for those people who think it's north of 5.
No. If you're talking.
Very shy, folks.
China?
Yes. How many people who think it's north of 10?
Tell
Yeah.
me the country.
Yeah. Well, there we go. China.
China? Yes.
China, Singapore, Korea. There you go.
I think that you have hinted at this, but I want to say a little bit more about the geography. Can you talk a little bit more about where affordability is the worst? Sun Belt, coastal regions. Anything else you want to add on that?
Well, we would agree the Southeast is where where we're getting, and I believe the suburbs of Texas used to be supply elastic. I wouldn't say it is supply elastic anymore, but still more affordable.
More affordable,
Although,
for sure.
For an example, a market like Austin, believe it or not, used to be affordable.
Yep.
Not anymore. And Miami used to be affordable. No way.
No way.
And so, yes, these affordable markets are rapidly being discovered and turned into non-affordable
The
markets.
coasts have been unaffordable for decades because they haven't built much for 4 decades.
And people
But
continue to want to live
What's
there.
different is, are these changes we're seeing in the Sun Belt, the high population, high job growth markets, are they long run, or are they a sign of something more long run? Or is it, this what we discussed at the beginning? Is it COVID, supply chain disruptions, the disassembling of the building industry and the GFC? If you made me bet, it's going to be longer run with them. It's a big change.
We always think supply is one way that can help us improve affordability. And I think what I'm hearing is that's still to be seen.
No,
But I
it
think
could.
another way of supply entering is single-family rentals.
But let's
and I want to bring that
emphasize
up.
before we go, supply could change.
Yeah, in the 50s and 60s, we built like mad, and to Susan's point, we were affordable. So
So in the time frame of
Could
what we're
happen.
thinking about
It could
this,
happen.
this statement
It could
about
happen in-
long run, like
Well,
how long
yes.
do we have to wait to see?
Well, okay, so yes and no. So
How
first
things
of
will
all,
shake up.
things could change.
I wouldn't bet they'll change, but they
I'm not
could.
I can't. I won't bet you.
It's good to have.
They're not going to change so fast.
Yeah.
However, there are ways it could change. So that's first. And second, we are right now not only at tight supply, but we are at high demand.
Yep.
We've got a tailwind from our demography. We've got the millennials are at their peak home ownership years, and they're buying. But that's passing. And if we wait long enough, another 10 years, actually, just like we're seeing demand for higher education dropping now, and unfortunately universities are feeling the pressure, not Penn, obviously, but going forward, we're going to see this translate into a decline in demand for starter homes. And we're going to see, just from the demand side, not from a shift in supply, at current levels of production, a resolution of this issue. But that's not this generation solution,
Yeah.
this generation of new homeowners. It's in the future.
Single-family rentals. I wanted to talk about single-family rentals as a solution to owning. If you cannot buy,
Yeah.
Joe, do you want to talk about
One,
renting?
I think it's really,
That seems to be a new thing that has helped.
in my professional lifetime, it's the biggest kind of new development in the sense of big institutional owners and purveyors of single-family rentals. Single-family rentals been around forever. It was just small mom and pops that are now big institutions. It's the short run, long run. It's a double-edged sword. If I am Invitation Homes and American Homes for Rent are the 2 largest owners that are publicly traded of SFR, single family rental. If I go out and buy Susan's house, the Wachter house, and turn it into a single family rental, well, I've got one added rental unit and I've got one less owner occupied unit. That's a zero sum game in the short run. We've got to build. So it's not going to make, it's certainly not going to solve the owner occupied affordability issue because I'm reducing the stock of that.
And that's totally true. Now we do have the new move is to build to rent.
Yeah, and then we can try to build. Exactly.
Build to single family rent.
Yeah. There are developments.
But it's small.
But it's that small. But the sector I think is important. Let's assume I'm going to be the pessimist on this. I think we're not going to jack up production. I think we have local control in the U.S. They don't like to densify. So I don't think that'll be an issue. But again, I'm looking at a lot of young people in the audience, and when you get to be 35, the data tell us you're probably going to get married, have kids, and at that point you're going to need that 1,800 square foot home in Atlanta. That nice 700 square foot apartment you think is great. It's not going to work with crying children, and it trust me. I went to that movie. This is a nice solution to it. If rates stay high and your income doesn't grow to support the high mortgage rates, this is a way to get 1,800 square feet in a nice school district, because that's what these firms are trying to do it for rent. If you can't get over the financial hurdle to buy, I think it is really interesting and could play a powerful role there. But just keep in mind the short run thing. As these firms buy these owner-occupied homes and turn them into single-family rental, it's zero sum. I took the Wachter house out of circulation for ownership. Okay, that's the only thing you got to keep your
there's a time frame issue.
Yeah, there's a transition period.
But for the young demographics who are looking for solutions, then renting is something, because one of our titles is the American Dream, and owning is historically something we connect with as the American Dream, but you want to live where opportunity is. That's also a part of the American Dream, and renting can give you that access to that opportunity.
You may not be able to afford
if mortgage
purchase
rates
the home.
Are going to stay high.
Yeah, depends on what you earn, what your income growth trajectory is, and the like.
That is a new product space, and there is more. It's good to have options in terms of having renting instead of owning.
Long run, I think it's a potentially important flexibility if you need a large amount of space but can't buy or don't want to buy.
But Susan is right. It's still it expands supply, but it is still a small base.
Yeah.
There is now build to rent, but that's still
we're doing some, but it's de minimis.
Yeah. Yes, we're a mature economy, so everything is going to move slowly. Yeah, but in time it will happen. I want to switch gears now to policy lessons. Our series is titled Policies That Work, and what the nice thing about being a researcher is you can read about a lot of research studies about what works and what doesn't work in the housing market in terms of policies. So Susan, maybe I go to you first. Can you maybe highlight a few policies you think the audience should know about in terms of elements of best practices?
First of all, I'll go broad, because I think it's important to go broad in terms of what's going on and advancing our understanding. Very painful to get inflation down. But getting inflation down and getting inflation expectations down is a necessary part of the solution. Because then, once we have longer-term expectations of inflation resolved back to the 2% level, then we'll have not just 10-year rates, but also the mortgage rate volatility will drop. And we'll also have a freeing of the supply and an increase in mobility. And that's going to be half of the answer. So who knows how long that's going to take, and who knows, again, the political winds on those questions. Impossible for me at least to think about forecasting what inflation under the political change is about to occur. So we don't know, but that is part of the answer. And that's why it's so important inflation, some people perhaps dismiss it as, after all, if inflation, if all prices or all wages go up at the same time, who cares? Well, there is another side of that, which is interest rate risk, and we pay for it. We pay for it in our major expense in housing. So that's first. The second is the supply of homes. And again, we will free up homes if indeed interest rates come down, because the lock-in effect will just be erased. It'll go away. So that will give us a third more housing, and that could happen. I was very optimistic this time last year. I said, stay alive to 2025, going after our dear Sam Zell, who said in 90, stay alive to 95, right? Because at this time last year, inflation was down to 2%. And by all measures, and then, and I'm not criticizing anyone, but then everyone decided to have a bit of a party and start various things, and we expanded, GNP growth started expanding, demand started expanding, and that's not a bad thing. We are now, believe it or not, growing at 3.2% real, and our population is growing at less, or maybe let's say 1%, and that means that Joe's point about productivity maybe being 1.5%, we're at 2%, which is incredible. But the other side of that is that demand is up, and so this is a hot market. So it's going to be hard to get inflation solved in 2025, but who knows? So that's one part of the answer. The other part of the answer, and I'm sorry being so long-winded, is supply now, but then going forward also supply, hopefully not hopefully, but it'll just happen in a world of less demand. So that supply-demand will come back in balance if we can do something besides this, get the inflation down and the lock-in effect on the supply side. And I think it's not impossible. And here, the pessimist economist in me, and I'm just as pessimistic really as Joe, so we can battle for the most pessimistic. But nonetheless, the policymaker in me says, well, isn't there anything we can do? And there are things that we can do. And there are states that are experimenting right now with solutions which are coming to scale, which could matter, even at this point, new build for rent, we could be at that level in these other initiatives. What are they? Well, for example, accessory dwelling units. And it looks like some cities may adopt, New York City may adopt, you guys, you've got a right to build in your backyard. In days of old, people often would have a home in a city, whatever, and they would rent out. Starter families would help to support themselves by renting out. This is another way of becoming a homeowner and getting some cash from renting and actually building. So again, this is going to be costly, but it does put a slightly different spin on the potential for solving this, or at least making some slight inroads in this long-run issue that Joe and Ed Glazer identified.
Joe, I had to go to you because we haven't talked about zoning yet. And
on the supply side, the foundation of my pessimism is outside of the cities, where I agree, there's a lot of interesting experimentation going on. It's local control. I live in a wonderful community called Swarthmore. We're in total control of who gets to build. Guess what? Nobody is pretty much the answer, because it's as dense as the community appears to want it to be at the moment. Will that change? One of the things Susan's talking about is there are states that are starting to at least think about, and some have begun to restrict the ability of localities to zone as tightly. They've done away with, only single-family zoning in certain jurisdictions and the like. Maisy, I'm in favor of anything that increases the supply. ADUs, accessory dwelling units, whatever. But I think we're going to have higher levels of government other than our individual communities with the power to do it. I think the answer, why do we not like building in where I live? I appear to be the only person in the community who does. Why don't we like it? Because new construction actually imposes costs and disamenities on us. It really does. But a state will actually care about the fact that you, another resident of Pennsylvania, might be able to move in and access a really good school district where you don't get the vote because you're not a Swarthmorean, so the Swarthmoreans can keep you out. It's a problem, but there's a political solution to it. And it's got to be politics. The market can't, given the way our federalist system works, the market won't solve this. It's going to have to be political.
Besides zoning, are there other solutions the audience should know about?
Well, there's a beginning of technology that matters. I just saw, a major company is moving to modular in construction. Again, it's like 5%.
Greystar did its first multi-story apartment complex modular.
And it will lower the cost, but it's not that difficult. It's difficult
absolutely.
Would it be a game changer? Is it big enough?
Scaling up is difficult.
Anything helps.
The Scandinavians are where we want to learn there. They do a lot more modular than we do. Mm-hmm. Yeah, it's got to be cheaper to produce it in a factory than on site.
Mm-hmm. But there are issues right now in making it scalable, but it could happen.
And whether people will buy it in the single family market. I think Greystar is a gigantic multifamily owner-operator. This is not yet being done in a big scale at single family.
Right. And it may not be as acceptable, and there also are code requirements, all sorts of stuff. Each locality has its own regulation, easier on multifamily.
The single-family builders aren't as confident people want the modular.
And also whether they're even regulated allowed.
Yeah.
Mm-hmm. I'm going to start bringing in some of the questions from the audience, and so I'd like to encourage the audience to use the text if you want to put in some questions. So one question that came in is, it has been mentioned that supply within the U.S. could change. I think we talked about that a lot. Outside of the macro numbers, what would be indicators of this change occurring? So I think it's about time frame, signposts, like what to look out for.
To see it happen, well, we have construction numbers.
Permits, yeah.
And permits.
In the United States, there's not an informal housing sector. So permits are where this stuff starts. And we can see it clearly.
The permits will there.
They're out monthly. You can see it in the permits.
Another question is about Fannie and Freddie. Susan, I think that's for you. Are we thinking, what will happen to Fannie and Freddie? I guess I'll keep it open-ended.
Can you read President Trump's mind?
Yeah. I guess I want to keep it more open-ended. I think ultimately the question is about how will it affect mortgage rates?
Okay. Well, that's a more specific,
to bring it,
Yeah. Well, there's a big controversy on that. There are those out there who say that if we privatize Fannie and Freddie, mortgage rates will go up an additional 100 basis points or perhaps a bit more, of course, which precludes it politically. That will make it not acceptable, kill what's the market from where it is now. But others say, and I was just quoted yesterday saying this, so I guess I can say it again, that if it were done appropriately, correctly, et cetera, that in fact it wouldn't necessarily increase mortgage rates. And the reason I say that is the way Fannie and Freddie are set up, one, and two, the way they're operating. They've been operating over the last 4 or 5 years, since the last administration actually, as a quasi-utility. They've been preparing themselves since the last administration, since Mark Calabria under previous President Trump attempted to privatize them and almost did, as though they were going to be quasi-utility out in the market. I should say two things. One, Mark Calabria was attempting to privatize them. Two, in response to that, this recent administration has, under Sandra Thompson, director of FHFA, continued to operate them as though eventually they would be privatized as a quasi-utility. But if they are privatized under this administration to come, how they were privatized, huge questions. We could spend at least a half hour talking about that. from my perspective, if they are privatized in a correct way, in an appropriate way, it will not necessarily raise mortgages. And I'll say why. Because right now, there is a charge for the risk of mortgage lending. There are two risks involved for mortgage lending. For those in the room, this is educational, want the fundamentals. There are two risks in mortgage lending. One is interest rate risk, and we've talked about that quite a lot. But Fannie and Freddie do not have interest rate risk. They offload that entirely to the market. So that's not a risk we need to worry about in terms of that aspect. If they're privatized, that ought not to change, assuming that the basic underpinnings of Fannie and Freddie, which is, again, we're now in the weeds, the TBA market continues to be set up and trade, and that's perhaps not something we should just throw under the blanket. It is important that we keep that in mind, although no one's talking about touching that, since it's a remarkable way of getting low-cost lending into the potential homeowners, home buyers. The second risk, of course, is default risk, and risk for foreclosures, which all borrowers have to pay for because investors have to be paid in return for the risk that their mortgage isn't going to be repaid. Well, Fannie and Freddie are in the business of ensuring that investors will never bear that risk. But Fannie and Freddie bear that risk of deficits, of defaults, excuse me. So Fannie and Freddie bear that risk, but they charge for it. They charge 50 basis points for it. And we look at actually the risk, including the risk of the GFC, and we look at the 50 basis points, and we look at the capital that they will have to have if they privatize, which will be in the hundreds of millions of dollars by regulation. And the combination of four things. One, the ongoing charge. Two, the capital buffer. Three, there's a line on Treasury of $250 billion. So they're putting the line on Treasury together with the capital that they're going to have. It's about $500 billion. Four, about half of their credit risk is already put out to the market in something called credit risk transfers. So they're in very good position to actually, with the current 50 basis points, cover even to the extent of a great financial crisis. However, given all of that, there needs to be some kind of backstop that the market will say, okay, it's not just Susan Wachter's calculations. There's something there in terms of if the crisis absolutely blows up. So that kind of commitment fee on the part of Treasury to backstop, which would never be, under any circumstances, even gotten to, except for, of course, this line, possibly, but even that's unlikely. That kind of commitment fee paid for by the privatized GSEs, just like banks pay for through the FDIC insurance, which, if there were a crisis, the banks have to then repay, and the same thing the GSEs as private entities would have to be repaid. So with all that in place, I do think, if done appropriately, big if, that mortgage rates would not have to go up. Now, there's all sorts of questions about whether it's likely for the GSEs to be privatized or not. And I think that's really a big question mark of whether they will succeed, but I do think that there will be an effort in this administration. Why do I think so? Because we have a letter from the president-to-be who says that's the first thing on his agenda, that he will indeed privatize Fannie and Freddie. So it's out there as an intent.
But as always, I think it's the details and how it happens that's going to be very important. Joe, I think this question is for you. There's a discussion about single-family rentals, and I think there's a lot of questions about the role of institutional owners.
Right.
Will regulation come soon? Will that affect affordability? Should we be thinking about the role of institutional owners in affecting affordability? And will they be regulated?
Political risk is real in that business, yes. There are important senators who have sent letters to these companies and the like. So yes, political risk is high. And it arises from the short-term problem that when they go into a community and buy Susan's home, and many times, if you're Susan's neighbors, they bought your homes too, okay? And it bid up owner-occupied prices, and that makes people unhappy. Although if you're an existing homeowner and you were down the street from Susan and her neighbors, you just got a capital gain. So, but the higher prices in the short run, because this is zero sum in the short run unless we're building Susan's communities from scratch. That's a risk. In the long run, I don't think they're going to cause owner-occupied. I don't think they're the primary cause at all. They're a small secondary cause of really high prices today. It's production costs, it's the operating costs and the like that are driving that. And so in the long run, I'm a fan of the sector because it provides flexibility in accessing single-family housing for people who may not be wealthy or rich enough to own. But yeah, regulatory risk is real for these firms.
Yes. Another question that came in, do you think 40-year mortgages are an effective solution to affordability? What are the chances that these become real?
0.
Another question. Do you want to expand on that, Susan?
Well, the way the 30-year came about is if people start with kind of a permanent job at 30, and then they retire at 60 or 65, they've paid off their mortgage. So today people are becoming first-time homeowners closer to 36, 37, 38. Give that 30 years and we're almost at 70. If we give it another 10 years, we're almost at 80. And the idea is that actually, and it's I think brilliant, that as you retire, 1/3 of your expenses are covered by either continuing to live in your home or by selling your home. And that is not only important from a social perspective, but it's also important from keeping default rates. And can you imagine the horror of having to evict people who can't pay? That's a horrible image and a horrible social result. And in addition, it has the effect of raising default rates, which we all pay for. So indeed, expanding the term would decrease the cost and increase affordability, but it's simply not workable in terms of the importance of home ownership through the life cycle.
I agree completely. The only way it would work is if the government took on the program itself. Imagine you're running a bank, and Susan just described that if you issue a 40-year mortgage to Maisy, who's the youngster up here, she's going to be retired without an income quite a few years before the end of that mortgage term. Do you really want to bear that risk when she has no labor? And the answer is no. The private sector won't do it, which I think is why Susan says it ain't going to happen.
I know. I teach this in my global class too, which is outside of the U.S. It's not the norm to have 30-year fixed rate mortgages.
We're the oddball in the world.
Yeah.
We're unique.
That's
a better word.
I want to move to other questions because we actually have a lot of good questions coming in. And so one question, I think this one is for you, Joe. I'm a homeowner. I'm going to rephrase this question a little bit. I'm a homeowner, and if I vote to expand supply, isn't that going to reduce the price of my home, which is a big part of my wealth? So is that a big part of this political resistance?
I think there's a belief out there among some sophisticated, this is a sophisticated owner who goes, look, if there's a big enough surge in supply, could that lower house prices? Sure it could. But on the margin, this is not going to be a really big deal. But, if we went back to 1950s and 1960s levels of production, and we did it in Boston, New York, LA, San Francisco, and the like, they'd become much more affordable, which means existing homeowners would lose some of the windfall that they've had. But unless you're for marginal changes, it's not going to be that big a deal.
Susan, I think this question is for you. Is there an argument for the GSE to widen the definition of a conventional loan to include variable rate mortgages? To make the mortgage market more responsive
They do
to
have a
effective
variable
rate?
rate mortgage.
They do. Yeah.
They do. They have it.
But I thought-
It's borrowers who have spoken in the market for the 30-year mortgage.
Another question that's coming in, I think it's about the role, how important is labor and immigration for production cost?
Very important.
I think we've talked about how inflation.
We well may
yes,
find out
yeah.
soon.
Do we
so.
know that?
Well, there's some evidence historically. Some studies look at previous attempts to affect the labor market. And we can look at numbers. 15% of the labor force is been estimated by Pew, actually 13% to be precise, to be undocumented workers. And so if that goes to zero, estimates could be doing back of the envelope stuff that costs could go up maybe by 10%.
And you mean in construction?
Yes.
Yeah. Yeah, it's a big enough number that if they disappeared, costs would have to go up, right? I'd have to hire her and to come in and do the drywall or whatever. So yeah, I mean, it's a big enough number, it would be economically meaningful.
Another one that's come in is about insurance rate price increases with increasing natural disaster costs. Do we think that's gonna it's meaningfully impacting costs?
Depending where you are, for sure, absolutely. So if you're in a vulnerable area, southeast near the coast, absolutely, costs of Florida have increased dramatically. So that for 10% of the homeowners, insurance and property taxes are more than the mortgage payment. That's only 10%, but it's normally, that just doesn't happen, not even for 1%. So who are those 10%? They're on the coast.
Yeah, I will tee up, I think, our colleague's work, Ben Keys.
Ben Keys, yeah.
Look up his work. He has a lot of new data about home insurance costs, and that's really, it's remarkable. Just a lot of questions coming in. Is the American dream going to be affordable for all? If not, what is the average income projection for those who will be able to afford it?
I don't know the answer to the latter question. It's certainly not affordable for all now. And, it depends on how you define the middle class. Susan went through the numbers, $70,000, $80,000 household income, somewhere around the median. If it's 4-to-1, price to income's 4-to-1, you can go out and get a mortgage from a regular bank and they won't laugh at you. But if it's 5-to-1 or 6-to-1, they're going to start looking really closely at you and going, do I really want to do this? Because they're worried about default risk. So it's already unaffordable for people earning less than $100,000. When you think it's unaffordable.
There's another solution. There's really a trade-off here, and the trade-off in some ways is it's not a trade-off. It gets worse, but. For those with family who can help, and many people, more than a quarter of people who buy homes are helped by family. And today, we have the highest home equity wealth.
Yeah.
So for those whose parents who are owners,
mom and dad.
Their mom and dad's wealth has exceedingly increased. Now they can't, which is typical historically, repay their mortgage, refinance, and use those proceeds to pay. But if they're sitting on other assets that they can use, and often they are, stock market, whatever, they can help their children. And they could also help their children. And by the way, so this means that if you pay more of the mortgage in a down payment, 30%, 40%, then your payment to mortgage, your mortgage payment to income ratio is far less of a problem because you're not paying that much. So then if you have a $50,000, $60,000, you can afford the median home if someone's paying down, increasing your down payment, paying down the mortgage. So that's a solution for some. Another related solution, which we see being used more than ever historically since the Great Depression, is that parents are helping their children by saying, okay, come on home, we've got that bedroom, we haven't converted it to a playroom study or whatever, a bar or whatever, so come on home. And more than 50% of young adults are now actually at home, and that enables savings. So it's a second way of helping to become homeowners, but at a higher age, so that the American dream may be deferred for many. However, for those, but still attainable, but for those whose parents are perhaps not homeowners, this is a real issue.
Yeah, and so it's skewed across the income distribution. The more,
Yes.
the better off of us will help our children.
If you allow
but
your
if
kids to
you're
move back
not
in.
among that, if you're a renter, there is no benefit, there is no home equity by definition, and it just so. I don't know that it won't work at the lower end of the income spectrum.
Another question, would relieving lock-in free up any net supply? What is the mechanism? Downsizing?
No, that's 0-1. If I'm locked in and I don't list my home, I'm not buying it, right? So if that's the question, the problem with lock-in is you who are looking for a new home, a third of the stock that you would see, you don't see anymore because Susan, Maisy, and I aren't moving because she's keeping the 3% mortgage. That's the issue. It's not that, right? I mean, there's one unit less demand if I'm locked in. I'm not searching for a home if I don't list my home.
Yeah, but it's not a one-for-one. What it is normally our parents are downsizing, and they're not downsizing.
That's true.
So that's a supply side effect, actually.
What do you predict to be the future of renter wealth creation?
What does that mean?
Well, I have a thought on what that means.
Yeah, Susan.
So there is a policy that HUD has put into place in testing, which is that Section 8 assistant voucher holders, not all, this is a pilot study, get escrow, that if their income goes up, their wages go up, their payments don't go up, but their extra income goes into, a third of their extra income, which would normally go to higher rent, will go into escrow account.
Yeah.
So that by the time, 7 years or whatever, they hold it for, but then you have a chunk of money which either you can use for whatever you want, or maybe you exit and at that point use it for renting in the market, or even a small percentage become homeowners. What if in the space of inclusionary housing or workforce housing, which we know that there is a lot of philanthropy interest in workforce housing and there are REITs there for workforce housing, what if, as part of the rental agreement, some money is put into escrow accounts as part of the rental? And I think that this is it's not that it's a dream, it's like a fantasy. There are some renter firms that are experimenting with this. Let's see how it goes.
Can I just add something about the market? To Susan's, that's a policy issue. Remember, if you're renting, you don't have a mortgage payment. You do have a rent payment, but remember, you have other costs that your landlord's bearing. That's why you're paying the landlord rent. You can invest it in the stock market.
Yes, there are other avenues of wealth creation.
If you rented the last 5 to 10 years, you should have a lot of stock wealth.
Yeah.
Unless you blew all your money.
We have our colleague, Peter Lindemann, who helped found this department along with others of us. And our first paper together that he and I wrote was on constraints of homeownership and how important it is to be a homeowner. He wasn't a homeowner. He was a renter and just put his money in the market.
Remember,
so it's an alternative.
This is the user cost of housing. I teach housing markets next term. It's not, you can save a lot of money.
If you can save.
If
but you've got to
you're
be in
not
that
owning.
part, but you've got to be in that part of the income spectrum, obviously.
Yeah, you got to save.
And today rents are high and increasing, so it's actually harder. But that's
not compared to the user cost of owning.
Not compared to the user cost.
Remember, you got to own or rent, so it's all relative.
Correct.
I mean, that's a great way to end because our panel is on real estate, interest rates, the shifting American dream. And I think today we had a lot of useful knowledge about how to think about whether homeownership is accessible, what is homeownership, some solutions to it, and wealth creation. So thank you very much, Susan and Joe, and thank you to the audience for joining us.
Thank you, Maisy.
Thanks, Maisy.